Joining me from New York, which I understand is going to become a socialist republic in short order, is Caleb Silver. I kid, of course. Is Caleb Silver. He is the editor-in-chief of Investopedia, friend of the show, formerly head of business coverage at CNN. I try to give you pride of place, Caleb. What are you like, the Philip Michael Thomas EGOT winner of full disclosure, or do you prefer to be the Steve Martin SNL equivalent? You name your own price.
I like the Steve Martin version. I want multiple guest gigs on one of my favorite shows of all time. Full disclosure, being with you is one of my favorite things. So
Oh,
thanks for having me back.
shucks. This is like sublimation for me because I always wanted Caleb to be my boss. I was always chasing him. He left Bloomberg, he got to CNN, he did amazing things at CNN, work with Wolf Blitzer. By the time I caught up with him at CNN, I was like, let's get the band together. Let's do something. He even use the phrase, one of my favorites, to be creatively promiscuous. And by then
Yes.
you were already working on your exit strategy to Investopedia. And I can't imagine what you have in your plans now, but Investopedia is certainly working for you.
Yes, it's been 9.5 years. I thought it'd be 6 months, turned into almost a decade now. And still here. Investopedia is 26 years old. I'm just a little bit older than that. And we are still symbiotic. I have the privilege of being the editor in chief and the face of the brand and the spokesperson for Investopedia. You know what's really cool, Robin? Wherever I go, Investopedia is such a well-known name, and I'm not taking credit. This is years and years of work and all of our editors. But when I meet people for the first time, the next thing out of their mouth is usually thank you. Who gets thanked for their job except firefighters and surgeons? But people really have a special place in their heart for Investopedia. So it's my honor to be the editor in chief.
It's a great portal. It's a great financial education term. I mean, when I'm, trying to interview a bond manager or something, and they talk about duration or defeasance, I'm something. The YouTube, the Google hits take us there. We're going to get into AI in your field, but first, I want to ask you. You talk about 26 years again. You see, you're young, but I have a lot of gray beards here. I'd like to take you back to the turn of the century, Caleb Silver. I believe maybe you were at CNN FN back then, and this is Cisco was on the brink, they would say, of becoming the first $1 trillion company in in 2000 US dollars, back in Y2K dollars. It didn't happen. Obviously, it was a big insurmountable thing. It was going to hit 300, 400, 500 billion. Now we have NVIDIA, as you guys have documented, the semiconductor insurgent, global insurgent, has been the chief beneficiary, we would say, in the stock market of the AI revolution, clocking in at $4 trillion. Talk about that.
Yeah, are you not entertained? A $4 trillion company, $4 trillion market cap, and that's Nvidia. And in a lot of ways, I like that you brought up Cisco. They're not that dissimilar, except Nvidia has far better margins, and the chips it makes are teeny. The GPUs are teeny compared to the huge systems that Cisco Systems was making to lay the railroad track, so to speak, of the internet. Well, Nvidia has done a lot of that, and it's not like it just got here. The company went public in 1993. Only took 30 years to get to $1 trillion market cap. But then, Robin, it only took 7 months to become a $3 trillion company. And then it took about 15 months to become a $4 trillion company in terms of its market cap. So it's the dominant player in GPUs, in making chips, but it's been in front of the right industries all along the way. When you think about gaming, it was making GPUs that were great for gaming, for the visuals that you need in online
Yeah.
gaming. Then it moved into cryptocurrency mining and creating processors for that. And then AI. And now it's super well positioned for the future of AI, which is robotics and these agent-led AI devices and things that we're going to use in the future to do things like our dishes and sweep our porches and stuff like that. So it is right place, right time, well run by the same person, and now biggest company in the world, also one of the most widely held stocks in the world, and it's kind of a proxy for the stock market.
And the stock market right now, the S&P 500, this as the $4 trillion stock would be on and off the biggest component. Does that trouble you that 1/3, according to your website, 1/3 of the S&P 500 is tech, information technology? We haven't had that spirit here since March of 2000, if you will. But again, am
Yeah.
I anchoring myself to a way distant imprint, a way distant memory? I mean, history can always rhyme, but no one's to say that NVIDIA, with its margins and its heft and the size of this revolution, can't become a $5 or $6 trillion company.
I was just talking about that on Instagram and TikTok, with the fact that it could easily become 5 trillion or 10 trillion because it is the dominant player in the industries that are growing the most. And no other company has been able to, grow profits 100% year in, year out, and grow its profit margins as well. So it has much better margins than a lot of other companies. But when you look like the leader, when you look at the leaders across the technology sector and across AI, they're making real products for a new revolution that we're just in the early innings of. So yeah, growth could continue to get. We can go bigger from here. And the fact that it didn't take that long to go from 2 trillion to 4 trillion tells you it might not take that long for it to double again, because it's the law of large numbers. Once you get that big and everybody's invested in your stock, you're the biggest stock in the market weighted indexes like the S&P 500 and the Nasdaq. When everybody buys those indexes through an index fund or ETF, they're buying Nvidia by definition. They're buying the big tech stocks, the Mag 7, if you will, and the AI associated names with it. So the more we buy the market, the more we buy Nvidia. The more we buy Nvidia, the more the market goes up, because it's such a heavy weighted stock in that index. It's kind of become almost a value trade in a lot of ways, even though it's a super growth company.
And I think one great investor I spoke with recently said that this is akin to fishing, a fishing net and trawling in the deep seas. That you get a lot of bycatch, you get a lot of dud fish, a lot of things that are supposed to be thrown back, a lot of things you're not going to eat. You'll get obviously a lot of plastic waste, unfortunately, but there are a handful of big, gigantic, chubby fish that you will sell at market. And similarly with the stock market, when you get that sample size, even if it's capitalization weighted, it's like pharmaceuticals, for every one or two major winners, they will account for the majority of the return of your portfolio over several decades. And there'll be so many duds, so many companies that get booted from the S&P 500, so many of yesteryear's stars. We think about Westinghouse or, Anacott
Kodak.
Steel, Kodak, right? That were
Yeah.
stars of yesteryear.
You're absolutely right. And when you look at the dominant companies over the last 6 decades or so, you see this big shift in the way our economy works and what was important back then and what's important right now in terms of what investors are focusing on and where the growth is. Because ultimately, as investors, we're paying for growth. So the money has been behind growth. That's meant technology. That's meant AI. That's meant some consumer discretionary tech stocks like an Apple, even a Tesla falls into that category as well. But you go back to the 1970s, and who do you see in the top 10 on that list? You see Texaco, you see Kodak, you see Sears, you see
What is it, like
GM.
Union Carbide and others? I mean, it's
Absolutely.
nifty
Roll it
50
forward,
companies.
roll it forward 30 years from there, and you start to see the Cisco Systems of the world. You start to see the telecom players get bigger and bigger. And then roll it forward to today, and who do we have? We have Amazon, we have Meta, we have Alphabet, we have NVIDIA, of course, we have Apple, even Berkshire Hathaway is there. But the way that our economy is transformed by the companies that have transformed it to become the biggest companies in the world, it's fascinating to watch, but no empire lasts forever.
It's interesting. I thought about that, and I thought about our conversations when I finished chemotherapy and radiation. We took the kids finally to Disney World, and they were late for Disney World. It's ideal time. Never that there's a perfect time to do it, but this will timestamp things. It was the back in the day, it was the General Electric carousel of progress, where you had the animatronic, turn of the century guy with his ice box telling his wife in the other room that he was going to buy her an iron to replace the steam iron. It's now is the time. Now is the best time. And it was the least visited, most threadbare ride in all of Disney World. And the GE sign was kind of, GE used to be so prominent. It was almost a proxy for America and the S&P and everything else. And no one talks about it anymore. And that would have been unthinkable to us having the same conversation 25 years ago.
100%. And now NVIDIA has become not only the most important stock in the market, but NVIDIA's earnings reports, which they do quarterly, that day, that report post bell, whenever they report, is probably the most important event in the stock market,
Isn't that crazy?
superseding Federal Reserve monetary policy decisions, jobs reports,
Yeah, it's
new
like when
business
ESPN
policy
had
pronouncements.
ESPN had LeBron's decision. That's what Bloomberg and CNBC do with Nvidia reporting, And similarly, back in the day with Cisco and JDS. But I'm dating myself as I always do. I have to tell you though, the interesting thing, and you're uniquely great to talk about this in that your cover of sustainability and climate, is that this is where the old economy and the new economy seem to unfortunately converge, because this is extremely energy intensive. I mean, we knew that crypto mining was, but when you have these gigantic data centers that are being built, and in an individual query can be so carbon intensive, and the United States is already behind the curve in terms of its baseload power grid, coal, natural gas, whatever it is. Nuclear has been neglected now for 15 years. Solar is a bright spot. It is unfortunate to think that if you put in one of these crunch heavy queries to a chat GPT or a mid journey, that it's actually burning something and worsening our crisis.
Yeah, and it's not a accident that some of the best performing stocks over the last couple of years have been power providers to these server centers that are churning our data and our information. And folks, when who are listening, when you're driving or flying across country and you're looking down and you're nearing the airports or you're flying over these major interstates and you're like, what are all those
Oh yeah,
beige buildings? Guess what those are? Those are either fulfillment centers for Amazon
for
or Walmart
Amazon,
or pick your
yeah,
e-commerce retailer that are
or
sending
data
things to you
centers.
so you can get them the next day, or data centers containing even a more valuable commodity, our information, our data. That is the currency of the 21st century. And the biggest private equity firms and real estate investment firms in the world, what do? They buy warehouses. They don't buy apartments. They buy warehouses, because in warehouses you can either put fulfillment goods or you can put server centers. And that's kind of our economy today.
That's the crazy thing about it. It's supposed to be asset light. I mean, there's a big opportunity cost. Obviously, you're digging up a lot of virgin land. Hopefully, some of them are brownfields, but the blight on the New Jersey Turnpike, if you see these things are city sized, and the demands for them, you're already seeing city councils up in arms. And I think that the backstory is fascinating to me. Back when I was covering markets at Business Week or at Smart Money, we didn't have anybody coming in and pitching us on the inevitability of kilojoule intensive AI, and this is why you should be investing in utilities or natural gas providers and everything. It's a lot of what's gone on in the past 3 or 4 years feels like an AI hallucination, if you will.
A little bit. I was at Bitcoin 2025 a few weeks ago in Las Vegas, and Bitcoin is notorious for using a lot of energy to mine it. You need a lot of processing power. Takes a ton of energy. Takes water. Takes all types of resources to get those machines cranking to mine Bitcoin. But an entire part of Bitcoin 2025, one of the aisles was just new and less energy intensive ways of mining Bitcoin, or cooling processing systems, or using sustainable resources so that you could create more energy at a lower price with less impact to do cryptocurrency conversions or processes. So I think the industry is waking up in a lot of ways, just because it's becoming a drag on its margins to use so much actual power that they're looking for more sustainable, cheaper ways of doing it. And hopefully that'll be a good development in the industry versus one that just continues to churn and
Well, you
eat
you did
energy
see
like that.
they are firing up 3 Mile Island again. And the BBB bill that just passed, I mean, is not exactly prioritizing clean tech. I mean, it's more drill, drill, drill. I don't want to go into too much of a detour here, but I think it's an interesting parlous time that you're right. These two areas of the market have been super, super hot. And it's a strange coincidence because they normally don't correlate high tech and smokestacks.
Yeah, and now you can't have one without the other. And now we're seeing, investors have woken up to that in a big way, but also there is an insatiable demand for that data. And when you think about the future of AI and what's coming next, that's going to require even more processing power, which is why another reason, back to Nvidia, why that stock is at an all-time high and crossed the 4 trillion mark. It's the leader in the industry, in an industry that is, call it the second inning of a 9 inning game. And we're going to need a lot more power, as we should say, and that power's got to come from somewhere. So
Full disclosure, I'm Roben Farzad. It is a joy. Actually, this is not work for me, for anybody who's watching it, to host Caleb Silver again. He is an official friend of the show. This is the next best thing to working with him, working for him. He is the editor in chief of Investopedia. In a past life, he ran business coverage at CNN, worked with the greats, Myron Candell. I mean, Lou Dobbs before he took that creative detour, worked with Wolf Blitzer. He was at Bloomberg. We just missed the chance to cross paths, but this is the next best thing in kind of 2025 style. And hopefully it's not that labor intensive. But I do have to ask you, I did mention the BBB, and it surely caught your eye that there is a chance now for U.S. born infants to be seeded with $1,000 to invest in. And nobody seems to realize the power of that compounding. The fact that, for so many people that do not have generational wealth, that don't have the parents with the resources or the presence of mind to be invested in a 529 or Roth IRA or retirement plan or have tax planning, this could be a sea change for a lot of Americans.
yeah, I was actually one of the better parts of the bill, if you ask me, because we've been talking about baby bonds for a very long time in this country. Seeding kids or families, young families, with a savings account or an investing account for the child at birth that can grow with them over time. Because the most important component in investing is time. That's where the magic of compounding happens. So $1,000 and parents can contribute up to $5,000 the day a kid is born. That could be huge when you think about the returns that we've been getting in the stock market for the past 20 or so years, 10% annual returns a year. I'm not saying it's always going to be that way,
But
but we
when
can
that
always depend.
happens, your money does compound, does double roughly every 6 7 years.
Absolutely. I have a presentation I like to do with high school students, and I call it the Caleb Index. If my parents put $10,000 in the stock market the day I was born in 1970, that'd be worth probably around $700,000 today, just in the Dow Jones Industrials. Well, they didn't do it, and I still love them, but it just shows you the earlier you start, the better. And sometimes all you have to do is get it started, push that snowball down the hill, and let it collect and build over time until it's a huge snowball that you can build a real foundation on. So seeding families with that is, I think, a great idea, and the fact that you could invest it in an index fund that tracks the S&P 500, it's great. Get kids started on that early, then teach them what is in it, how it works, so that by the time that they are ready to manage their own money, they are familiar with the way investing and compounding works. They understand how to grow money, and they can start to build their own generational wealth.
I had this very thought when my daughter was born, and we're doting on her. It's an amazing experience. We're saying, do we have enough of the receiving blankets? I'm going somewhere with this, trust me. But in walks in this young woman photographer with a complete kit, and she'll swaddle her and she'll pose her right after you nurse. I will put her, and then I'll burn it all onto DVD and CD for you. How can you say no? You're the most captive person in there. Like, who the heck would I be to say no to a $200 CD of professional portraiture of us that's going to take all of 10 or 15 minutes? And it got me thinking, to not that you're in any position to have a a Vanguard or TIA consultant come and see you in the birth room, but you're absolutely correct. That time is it's so money, and so few people start in grade school or in preschool. It's typically the first taste that we get is it's your first job, right? Where if you're lucky enough to have a 401k and match, and a lot of people are like, well, I want to have a lifestyle, I want to spend it in New York, and they end up regretting that by age 35. So there is something to be said, assuming that future returns even approximate what we saw in the past.
Yeah, and it's hard to bet against that because we just don't know. But if you kept betting against it for the past 5 years, 10 years, 20, 50, 100 years, you have been betting in the wrong direction. Warren Buffett would tell you that. So getting families and kids started on that wealth building early, I think is a fantastic idea. Plus, it gives them exposure to the way the capital markets work. And so they can understand, they can be an owner, not just a consumer. So many Americans are just consumers. We're awesome at spending it. We do it like it's our job. We'll do it even when we don't have the money. What we're not really good at is paying our future selves. And that's just because nobody ever shined the light on the fact that if you start this now, this could be 10 times bigger by the time you're actually going to need it. And I think we need to do that, a better job of that. I do spend a lot of time in high schools having this conversation. And you know what it comes down to in a lot of cases is just a lack of trust in the market. And I get that. I totally understand it. But when you start to show people how it really works, and yeah, 75% of the time the stock market's actually rising. Versus falling. And most of the time we're in a bull market, not a bear market. And then if you buy in the bear markets, you can do even better because you're dollar cost averaging into cheaper prices. All stuff I never learned. I'm an art major. I grew up in the restaurant business. I didn't learn it until I got to Bloomberg and I lost some money. But once you learn it, you realize that this is a lifelong journey. You can build real wealth and you never stop learning. So I love the fact that they want to get people started as early as possible on this. Plus, it exposes young families to the concept of saving and investing for the future.
Last week, literally, a 9-year-old asked me my opinion on Bitcoin. And I answered frankly that I can't really have an opinion other than I still don't understand it. 13 years into kind of knowing what it is, being asked about it all the time. And because I can't understand it or explain it or see the void that it fills or the pain that it solves, I can't buy it. Have you refined your pitch at all on this or explanation? Because I imagine when you go to schools, you're asked about this all the time.
Yeah, well, let's start with this. It's been the best performing asset, and I put that in air quotes for a reason, we've ever seen in the capital markets. The returns on Bitcoin are extraordinary from the
Tens of
time that it
thousands,
was
hundreds of
created.
thousands percent. Yeah.
Right. And so why is that? Well, there's a few reasons. Think of Bitcoin as a car that runs along a new highway called the blockchain, right? The decentralized network where everybody can kind of see everything. It's a distributed ledger where there's a record of everything. But on that, you can create different products and services and tools, and you can create tokens that represent the value of the transactions you can make. Bitcoin is the most popular token, coin, so to speak, that can reflect those transactions. And now it started as a software program to create a token that would be decentralized, not tied to the dollar, not tied to gold, so that it would operate independently, but it was also a service for the unbanked. And there are tens of millions of unbanked people in the world that are underserved or just don't have access to regular financial institutions. Bitcoin allowed them to make transactions with each other using that form of digital fiat currency without having to have a bank intercede. Or if you wanted to send money home to your home country where your parents or your grandparents live from the United States and you were making it, if you did that through a Western Union, they'd charge you a big percentage to do that,
Or
right? You'd
or
have to,
or if you're an arms dealer or cocaine trafficker.
absolutely. You could send that without transaction fees, but also covertly, so to speak.
Right.
It turns out now that you can trace every single transaction that was ever made. So it allowed people access to a form of currency that was not tied to the regular system. And it became very popular. The thing about Bitcoin, there will only ever be 21 million that are ever mined. So it has a scarcity built into it as well. We're right at around 19.5 million or so that have been mined so far. It gets harder to mine as you reach the end, but it has the scarcity aspect to it. So it's not like the dollar where you can just keep printing it if you're a treasury or a central bank to make the economy feel a little bit better. And then you get inflation and rampant debt. It's got a limit to it. So over the last few years, we have seen the biggest financial institutions in the world, the Fidelities of the world, the BlackRocks of the world, accumulate and mine their own Bitcoin to have a huge reserve of it so that when we have an economy that actually uses it much more robustly than it does today, maybe you can buy a pizza with it, maybe you can do other things that
Who
they
want
want to
the
be able.
people who bought a pizza with it in 2013 rue that day
That's the
because it
most
ended up
expensive
being a
pizza of all time.
fifty thousand
So
dollar pizza, right?
I'm giving you a long explanation, but it is a digital currency. But it has come of age in a world where digital currency will be the new normal for our kids. They may have dollars in their pocket or a debit card or be able to cash app each other actual fiat currency, but that's a form of digital currency in a lot of ways as well. In a lot of ways as well, Bitcoin is that too.
Caleb, when I
It's
was that kid's age, first series garbage pail kids were my Bitcoin. That doesn't mean they have
absolutely
to be that. And I know I sound like Archie Bunker and an old timer and, poo pooing this thing, but it still doesn't. Where's the pain? I understand it's whimsical, it's great, and there's a lot of FOMO when asset managers and others catch on, but you know the definition of speculation. It's like
yeah.
assuming that the next guy is going to be the
The
one
greater
holding the
fool
bag.
theory. What's the next
Right.
fool willing to pay for it? And with Bitcoin, the next fool is willing to pay a lot for it, as it turns out, as it dances around record highs. But a lot's happened just in the last few months under this administration, right? They have created rules around stablecoins so that stablecoins, which are pegged to the US dollar, but they're digital currency, can now be incorporated into the banking system. The president wants the United States to be the crypto capital of the world, mine its own Bitcoin, and keep the Bitcoin it has in its own treasury because it knows that other countries are developing this very quickly and using it more robustly. And when I was in Las Vegas at Bitcoin 2025, there was an entire aisle of lenders willing to let you use your Bitcoin as collateral to borrow to buy a house, to borrow against for a personal loan. There are credit cards now that are issued by major credit card issuers that will give you Bitcoin rewards for buying your groceries or buying a plane ticket. And if you don't have exposure to this asset class, you are going to be left out of yet another development in the capital markets that will probably be the new normal for the next 3 to 4 decades.
So, at the fear of sounding wonky, isn't this going to be co-opted by the S&P 500, just like they say the third parties are always co-opted by one of the major parties? And in the same way that you don't have to go out and buy individual gold ingots or buy a gold miner, that the S&P 500, the broad market, the total market index, even emerging markets or developed markets, if you want to diversify into miners, that gives you correct exposure to this idiosyncratic asset class. Does an individual investor have to go and buy direct exposure to Bitcoin? We know how volatile and esoteric it is.
No, you don't have to own the actual coin itself. You don't have to put it in cold storage in your own wallet on a key where only you know the password, hidden under the tomato plants in the garden where you're going to end up forgetting it. You can buy what we call Bitcoin ETFs, spot Bitcoin ETFs. They don't actually hold Bitcoin, They are a proxy for the price of Bitcoin. So if you want to believe that the price of Bitcoin or other cryptocurrencies is going to continue rising, you can buy an exchange traded fund that literally just tracks the price. So you don't have to actually own it. You don't need a wallet on Coinbase. You can get exposure that way, or you can buy stocks in the companies that have become Bitcoin treasuries. There's a company called Strategy. It used to be called MicroStrategy. It used to be
MicroStrategy here in Northern Virginia, Michael Saylor. Yeah, it's a
all
.com darling in 2000. I want to feature him on the show that has become this Bitcoin treasury play.
All it is a treasury now. It's stuffed its treasury with about
Wow.
$5 billion worth of Bitcoin, and it rises and falls as a stock as Bitcoin rises and falls. But then there are other companies that are doing this as well. Coinbase is an exchange for trading cryptocurrencies. That stock's been one of the best performers of the last year or two and is only going to get bigger as more and more people adopt this. So there are ways to get exposure to it. There are ways to just buy the picks and shovels around it. The companies that are building the blockchain or building applications for Bitcoin, or buy the cryptocurrency itself. But it is here and it is here to stay. And I don't think that I know it's esoteric and I know it seems out there for a lot of people. What you were referring to earlier, will the S&P 500 co-op this, is tokenization. And we heard an announcement recently from Robinhood, which was the original free trades online broker, that is going to create what it calls tokens to buy stock, phantom stock, in private companies like OpenAI. Now, OpenAI said you can't do that, but it doesn't change the fact that exchanges are starting to do this. Brokerages are starting to create proxies for real stocks and other products that are not the actual things themselves. They are a representation that you can buy, sell, and trade. What is this all coming to, Robin? This is kind of like the gamification of the stock market, digital currency, and the options market and probability betting all being slammed together at light speed. That's kind of where we are right now in the financial markets.
Full disclosure, do stay with us. Full Disclosure podcast to NPR, Spotify, YouTube, Apple, all of the podcatchers. A shout out to our radio listeners on WVTF, Radio IQ News, Virginia's NPR behemoth. Holler if you too would like us on your air. My DMs are always open. Find us everywhere and at one neat link, fulldradio.com. Again, fulldradio.com. If you're just joining us, my guest, friend of the show, Caleb Silver, editor-in-chief of Investopedia, which is now in its 26th year. Gosh, you are surviving the scene. There's currently a digital media die out, and people have all sorts of hand-wringing about AI and AI replacing things. Before we get back to markets and maybe talk about the Fed, does that keep you up at night, the fact that AI could have scraped your entire IP, everything that you guys work so hard to build, the definitions, the sections, the videos, the explanation things. And if a search is no longer leading to Investopedia, that it's OpenAI and the others that are just capturing the rents, the commission in that little blurb.
Yeah. It's not that they could, it's that they have, and they're not going to stop. So a couple of things on that. It's obviously a threat to sites like ours, which are providing explanations of things. You can find explanations for things through any of these, OpenAI, ChatGPT, et cetera. Now, our parent company, Dotdash Meredith, has a deal with OpenAI, a licensing deal, and they cite us prominently. But still, you want people to come to your website.
And to pause, give us all of the other titles under the Dotdash Meredith umbrella.
Oh, there's
just for
40
people
or
to
so
remember.
of us, and that includes people.com, Food and Wine, Travel and Leisure, Southern Living, Midwest Living. I could go on, brides.com. So we have so many great brands under our domains, and a lot of them are what we call intent-based platforms, right? You're not just browsing Investopedia. You came to us for a reason. You're looking something up. What's the difference between this or that? What should I do if, or what should I do with, right? You have questions. AI can scrape us and provide a lot of those answers using our content. So we were proactive in establishing a deal with OpenAI so we could be part of the conversation and not just sit there and let these companies just take our content. And we have other recent announcements that have come out to protect our sites from AI crawlers, but it doesn't change the fact that kind of the horse has left the barn. The data, the content is out there. We believe, and this comes from the very top down of our company, that our data is precious. Our content is precious. We work hard on it, and they are stealing it from us to present in front of readers who are looking for it. And so we have to find other ways to reach our audiences. And that means every single possibility has to be looked at. We have to go from being a place you find just through search to appearing in front of you on the other platforms directly. That means obviously videos on Instagram or TikTok, or good explainers on LinkedIn, or my podcast that I do every Monday now live from the New York Stock Exchange, or live events, which our company is really into when you think about Food and Wine and the Classic, and people's celebration of the red carpets and things of that nature. We are out there in the world, so we have to touch our audiences and reach them wherever they are in the very way they want to interact with that content. So a story on Investopedia has got to be different than me explaining something on video on Instagram. You got to do the right content for the right platform for the right people and be sensitive to that, but not be sentimental about the way your business worked and grew up over the past 26 years, because you will get run over if that happens. And we're not going to get run over. We want to be here another 26 years plus. So we've had to evolve the way we do things, evolve the medium, Robin, and the message, if I may go Marshall McLuhan on you, in order to stay relevant and make sure that this great brand is front and center when people are trying to make decisions about their life. One more thing on that. What AI is really good at is answering the question of what is. But what it's really not good at, and it might get good one day, is what should I do about? Now
Mhm.
what? The now what part of it. And I think that's where Investopedia's future is. Like, people can figure out what is, but what do you do? Well, that depends on who
So
you are, and
you
we're
read
good at
my
that too.
mind, because I'm thinking about the hive mind of AI and the investification of this. I'm thinking of Eric Balkunas at Bloomberg. I'm thinking about the Bloomberg terminal, and you're charging, ungodly amounts from hedge funds and Wall Street firms and wirehouses and Fortune 500 companies for this terminal that are going to demand the AI functionality. That there's going to be at some point, it's that mind might work better than the editors who choose the S&P 500. Do you see what I'm saying? When I think at night and I close my eyes, that this is replacing art departments at magazines. It's already replacing copywriters at real estate agencies. The ad industry is having its bout of fear and loathing. When is it going to actually help the mom and pop investor and
Well,
democratize a whole different layer of investing?
I think it can do that right now. If you say, give me a diversified portfolio of investments, I'm 45 years old with $150,000 in annual income, and I have assets of 200,000 and debt of 50,000, making it up. What's the best place for me to put my money now in the most tax advantage way? You're going to get a pretty comprehensive list. And everybody can start with a list. It's like having the ingredients to the recipe and the way to make it. But you're not going to make it perfectly and make it perfectly for you unless you either really know what you're doing or you work with somebody that really knows what they're doing. Now, I have a financial advisor. You'd say, why does the editor in chief of Investopedia need a financial advisor or planner? Well, I don't know what I don't know. And I don't know the nuances of tax efficient investing like they do. And I don't think AI can learn that as well. That are very specific to my needs. I'm complicated. My family finances are super complicated. I have a production company. I have LLCs for the movies I make, plus my W 2 income, plus what my wife does and other investments. So I want a really good pilot, a really good chef taking all those ingredients that they may have gotten from AI recommendations and saying, no, we need to do it just this way. That's how I make the most out of my money. And I really don't want a machine doing that.
Well, what is it doing to the robo advisor industry? I mean, they're all over. They advertise all over Investopedia. We know that millennials, younger people, love to take the human element out of it. In fact, if you take humanity out of it, you're going to be able to do the difficult things over long stretches that can help you double down when times are tough and resist the urge to sell, when times are tough.
Absolutely. And robo advisors, if you look at their evolution, started out as, hey, we're going to invest you, we're going to put you in a bunch of ETFs that do tax loss harvesting, so you don't have to worry about it. You can set it and forget it. And we know who you are, what your goals are, how much money you have, how much you can contribute. We're going to put you in this portfolio and make sure we're doing tax loss harvesting and making it tax efficient for you at the end of the day. Great. Now what have they become? Full service financial services companies that are offering checking accounts, high yield savings accounts, credit cards in some cases, access to a real advisor. They've had to evolve their platforms to be more than just that, because just that doesn't work anymore. Just like being just a site, a website that provides you definitions of financial terms doesn't just work anymore. We have to be more than that. All industries have to evolve: media, financial services, and every other industry you mentioned, publishers, media, broad media in general, everywhere.
Isn't it fascinating to you? And this is just like a little palate cleanser before we move on. That we said it before: the brokerage commission is all but dead. And in fact, when you look at some of these ETF expense ratios, it really costs nothing. You could come in and put $50 or fractionally into an S&P 500 thing. You could buy something on a weekly or monthly schedule for an infant, and yet they still advertise. They're all over CNBC. They're all over Investopedia. What is that pot at the end of the rainbow? Is it the entire relationship with a family, kind of tax planning, tax loss harvesting, Roth IRAs, retirement, checking, savings? I mean, I'm trying to square it with when I worked on the sell side. I mean, what is a Charles Schwab today? What is a Vanguard today? A Capital One certainly, which has just expanded. It has its bank. It bought Discover.
Yep. If you go to a lot of the financial services conferences that I do, or the ETF conferences, or the financial advisor conferences, you hear the word holistic a lot. Sounds like you're
Mm.
at some yoga retreat, but it's not. What does holistic mean? Full service financial planning. The investing part of my financial planning services is the smallest, least important part to me. I want gains. I want to beat the market. I want to protect the nest egg. Of course, I assume that my financial planner and advisor is going to do that. That's what the money's for. But you know what the real money's for? It's for my taxes. It's for my insurance. It's for my long-term planning for my parents. It's for my kids' college plans. It's for all the other things that are still confusing to me that I want a human being to have in front of him to touch, to explain to me and my wife to make sure we're making the right decisions. And I am not about to trust the machine with that. Maybe my kids will, and they're 21 and 19. Maybe they'll feel more comfortable doing that. But I know how complicated things are. I'm in this industry. So you see that word holistic all over the place right now. And again, the investing is probably the least important part. Talk to any advisor. They're doing estate planning, legacy planning, experience planning. That's what's happening in financial services.
Caleb, how do you think about cash and the opportunity of cash? And I know this is a different line of questioning than my typical shows with you, but sometimes when I'm there, I'm thinking, kind of, what is the smart money or a person? There are people out there that are playing the parlor game. They're going and chasing teaser rates on money market, savings accounts. This has to be linked to your American Express, X, Y, and Z. How does a person like you think about cash? The
Yeah.
opportunity of
Well,
cash. Clearly, uninvested cash when the market's at an all time high feels painful, but cash is also king if you have that dry powder when we are in a correction or a bear market.
I grew up with a little financial trauma. I'm pretty risk averse. I started working when I was 12 as a busboy because I wanted cash in my pocket, a wad of dollars, 21s rolled up. I thought that was a huge deal when I was 12 and 13 years old, riding back on my bicycle after a late shift. I like having cash on me just because I grew up in that era. I'm in my 50s, and having a wad of cash in my pocket made me feel secure. And I don't think I've changed much. I like to have cash on me. Now, why? Sometimes it just makes me feel secure. It's part of my financial history. So I have a connection to it. But there's also something that my kids don't really know or feel, which is you got 20 bucks in your hand, you go buy something at the supermarket or the deli or whatever, you walk out with eight, that feeling of, whoa, I just have less of what I started with is very different than the Cash App or using your phone to pay for something. So I also think it does something to you mentally where it helps you become a smarter saver and a smarter planner. But I'm also old school in that respect. In terms of money market funds, high yield savings accounts, and CDs, I invest in all of them. I'd like a little 5% return because I like to have a foundation of cash around me for emergencies. But also, you never know when you want to take a big swing at something. And sometimes there's no better way to do it than with the cash you have in a savings account that's been earning 4 or 5%. P.S. 4 or 5% is not bad at all for that extra cash, and you should be earning money on your cash. Just don't tell me that you have a savings account and you don't know the yield on it. Make sure you're earning more than inflation, and it's there for you as dry powder, as you said, for buying stocks, buying cryptocurrency, buying a piece of property, putting money down on a car, whatever you need it for, whatever that emergency is. Sometimes there's nothing better than the greenback, and as long as it still has its dominance in the world, I still want to have some in my pocket.
And speaking of this postscript and almost a record scratch moment, I was driving into DC last week, cross the Potomac, whatever, the 495, come in on one of the exits locally, and there's a homeless person holding up a poster with his Cash App and Venmo handles. And I got to ask you what you think when New York, time was you have $20 if you took a cab, and if there was any change, you would tip the doorman with the remnants. I mean, I only take out cash now for the barbershop.
Yeah, that's where I take it out. And I love to give my stylist a tip in cash. And I love to give the people that wash my hair a tip in cash. You don't use it as much as you used to. But sometimes I use it on purpose just so I can get that feeling of that actually cost me real money, and I'm going to feel it with a lighter wallet going forward. And most places don't, they accept many other forms of payment. But have you noticed, probably in in Richmond, that there are a lot of restaurants that don't want to take credit cards anymore because they don't want to pay the four
They'll
percent
they'll
processing
charge
fee.
they'll be explicit about the 3% pass through. And some
Right.
customers
So
actually now, on top of that, they say that the dreaded kind of tip prompt on the iPad, or the toast prompt afterwards, that
right.
cash, you can kind of discreetly put it in the jar. But it's interesting that there's this renaissance of cash, because similarly, merchants will tell me that the money that they have to pay to a Loomis Fargo or an armored guards or loss, shrinkage, counterfeiting, I mean, it cuts both ways.
Absolutely. And that's why it's another reason why you've seen the emergence of cryptocurrencies. It's like, what are we doing putting, you know, dead presidents and a lot of green and white ink on a 6 inch by 6.6 inch piece of paper that weighs 0.001 grams and calling that real money? I mean, it's kind of a joke too, in a lot of ways. That said, it is the dominant currency in the world, and that's how the world goes round, with that C note, still to this day, but it's changing, right? And I think the people that have developed cryptocurrency and the early adopters and younger generations, they don't believe in the sanctity of the greenback, right? Of fiat currency the way that you and I do. I'm still attached to it. But that's because of my history, right? I'm sure my kids won't even care much about it going forward. But if I'm going to hand them $100 bill, they're pretty happy to take it.
Shed a tear for the pickpocket, by the way. I wonder what they've kind of retooled and transitioned into. That's for a different episode. I'm sure we can find a retired reformed pickpocket. But you talk about fiat currency, Caleb Silver, and I have to get to this Federal Reserve. For as much as we throw around unprecedented in Trump 1 and Trump 2 especially, I've never seen a White House so at war with its Federal Reserve, which Trump picked in his first term. You used to have browbeating and moral suasion, and people, presidents extol low cost of capital, something that would unite liberals and conservatives alike. But this is outright Trump daily saying that he's awful, he should step down. And moreover, I have people there to replace him. It's kind of like where The Apprentice crosses paths with, what, how big is the balance sheet of the Federal Reserve, how many trillions of dollars. We're actually living this.
Yeah, no, this is real, and it's rare, and it's disrespectful. But I mean, I don't know what else we would expect out of this administration. And they did appoint Powell, and his term will end next May if he doesn't step aside sooner, and he promises that he won't. So, in a way, it speaks. You hate to see the independence of the Federal Reserve, which has been so important in stabilizing our economy through
Yeah.
so many crises, attacked like this, and its role in our democracy, right? It's rare to have a democracy where you have an independent body that sets monetary policy that is divorced from what's happening with economic policy, so that they can keep prices stable and the labor market intact. And I think we're blessed to have had it, but the fact that the president keeps dunking on it, I think it also erodes its own credibility in doing so. But people should realize that if it weren't for the Federal Reserve, then we wouldn't have price control. And I know we didn't have it a few years ago. Things got out of control, and they can be late to the party, they can be early to the party, but you do want a central bank that has its eyes on money supply and those two most important things in our economy. How much do things cost, and does everybody have access to a job? I can't think of two more important roles in the economy, and to have those divorced from the executive branch, which has its own agenda, I think is the right thing to do. Now, what's going to happen? Well, it's already happening. There's all this chatter about who the next Fed chair will be. They may name somebody or nominate somebody earlier than they have to. So they have what they call a shadow Fed chair, so that whatever Chair Powell and the rest of the Fed governors do is kind of overshadowed by what might happen next. But think
Yeah,
about
we
why the president.
we recently had former Richmond Fed President Jeff Lacker on the show talking about the shadow Fed. I mean, these are parallel proxies to what already was supposed to be an absolutely kind of an inviolable. You're not supposed to go there. It was supposed to be almost like a
Yeah,
separation of church and state, but he went there.
Yeah, he went there, and there's almost no separation anymore, especially with this administration. But like I said, you want the Fed, you need them on that wall. In other words, you want them on that wall, protecting prices as much as they can, controlling monetary policy to do that, and making sure there's ample jobs out there and the unemployment rate stays pretty low. But why does the president want and demand that Fed Chair Powell and the Fed lower interest rates now. It's not to make money cheaper necessarily so that we'll go out and continue to spend money. We're spending money even with credit card APRs at 24%. He wants it, and now he's been explicit about it because it lowers our interest payments on our own debt. Those are tied to interest rates. So if we're spending over $1 trillion to service our debt, and our debt just keeps climbing as a country because we keep spending money and printing more, then if you lower the interest rates and you lower those interest payments, it frees up money to build a wall, to do more kicking people out of the country. That's the real reason. So people should, when they hear the president say lower rates now, he's basically saying we have to lower the amount we're paying to service our debt. It's just gotten too big, and I'm going to have a plan to spend a lot more money. So this is just annoying right now. That's why he wants lower rates.
Caleb, every time I give I go give a speech through my bureau or at an event, I open it up jokingly and I point back to yesteryear and crises and bring up Paul Volcker's picture in the early 80s chomping a cigar, that inflation, the savings and loan crisis. And I always ask, is there a bond vigilante in the audience? Will you step up? What is a bond vigilante? They're kind of fabled at this point. Don't we deserve to get punished for our profligacy? And yet, what you saw with the BBB and the Congressional Budget Office has said that the amount that's going to be added to the deficit, you see how much we're paying just on interest to service our debt, and actually worsening the situation at a time when the Fed is really trying to slash, to kill, to slake inflation. Isn't there supposed to be an outside party that's supposed to come in and punish us for this, saying, no, I'm not going to lend to you at 4.5 points over 10 years. For this kind of activity, you got to give me 6 points. On a 30-year treasury, no, there's too much uncertainty. You got to give me 8 points. It's like we had that check, that bumper, that guardrail back in the day, but some sort of American exceptionalism has changed that.
Absolutely. Dr. Ed Yardini is the person who coined that phrase, bond vigilantes, saying that basically if monetary and fiscal policy got out of control and we spent too much money and we were driving our deficits even higher, eventually those who own our U.S. treasuries, especially the 10-year, the most widely held, most trusted asset on planet Earth, even over the $100 bill, they would simply demand a higher premium to own it because our economy became riskier. We have too much debt. We can't service our debt. And eventually that means a slowdown in the economy, a recession, and much worse. And they did for a minute there. And that's why maybe you saw the president back off of that tough tariff talk back in April. I think it was actually the drop in the dollar that got the president concerned. It used to be that the stock market was the guardrail. Back in Trump 1.0, when his policy moves rattled the stock market and caused a big sell-off, well, he would reverse course because the stock market was the guardrail. Not anymore. Why not? Because this administration and the family that runs this administration is deep into cryptocurrency, right? The president has his own meme coin. His company has its own crypto exchange. They're creating a decentralized finance company that'll be run by his sons. They're deep into crypto. So it's not the stock market anymore. We thought it was the bond market, but the bond vigilantes are afraid to come out. They still want to own our treasury bonds. Maybe it's the dollar vigilantes that say, we just won't hold the dollar anymore. It won't be the currency, the dominating currency that we do business with around the world. That's why the president slapped those 10% tariffs on India this week, because they're a part of the BRICS group of countries, Brazil, Russia, India, China, and North Korea. They're planning their own future in a post-tariff world that might not be dollar denominated. So maybe it's the dollar, but right now the bond vigilantes at least are using butter knives.
But outside of the reputational headline, and certainly, the U.S. dollar has had its worst start to the year since 1973. I mean, the time of Nixon and separation from gold. Why should that bother him? It's helping manufacturers. It's helping his heartland. It's helping this fabled Rust Belt sell its wares more compellingly to the rest of the world with a weak dollar. I know every administration, going back to my adult investing lifetime, has paid lip service to the importance of a strong dollar. But in practice, they don't seem to mind if it becomes collateral damage.
Yeah, they say they want a strong dollar, but in reality, 40% of the revenue that comes from the S&P 500 comes from outside the country. And even though we're going into a less globalized world with much more onshoring here in this country, where it's going to take years to do that. So you actually want a weaker dollar to propel those sales. That's 40% of the sales. 60%, though, is right here in the United States, right? So if you're traveling to Europe or you're traveling to Japan or something like that, and you have a weak dollar, you're going to feel it. And if you are making products here and you're trying to be competitive and sell them here, but the dollar is weak, but you're dealing with competition from overseas, that doesn't help much either. So you get a lot of push and pull on whether or not you want a strong dollar. But you and I remember how many magazine covers that had, the greenback and Uncle Sam flexing his muscle, and the dollar is so strong right now. Actually, a weaker dollar has been the wind in the sails of public companies in America for the last 30 or 40 decades.
Caleb, I always wish that I had 2 hours with you. I mean, we'd break them up into double episodes. You're very generous with your time. In the few minutes we have left, either a jump ball or, to ask you about diversification and timing. You've seen Ben Carlson. We both read him, with Ritholtz Wealth Advisors. There's always this anxiety when markets hit record highs, and we've hit so many records. We've been in such a chronic melt-up situation, even, through the pandemic. Stocks just keep hitting a high. We keep getting told about these CAPE ratios and NVIDIA, $4 trillion. Investors that I really respected came out 5, 6 years ago and said, at this point, I would start reinvesting my dividends into cash. I'm worried about the S&P at 20 times earnings or everything. And yet the market just relentlessly keeps going higher. Are you able to sleep at night saying that, you know, I have my debt paid off. I'm in a 60-40 guy. I have bonds as ballast in my portfolio, and that is the best that I can do? Or is there another way to give yourself kind of an added layer of sleep insurance in this environment?
I ask myself the same question, and I ask professionals too. And you mentioned Ben Carlson at Ritholtz Wealth. Well, the CEO of Ritholtz Wealth is a good friend as well. His name is Josh Brown, and he
Oh,
creates great
downtown Josh
content.
Brown. Yes, I love
Yeah,
him.
he creates great content with the compound and everybody at the Ritholtz Wealth family. And I had him on my podcast recently, and I was saying this too. Why does this keep going up? Right? When does this eventually stop? And he explained this to me this way, and this is the way I've been thinking about it a lot lately. What do we do every 2 weeks? Those of us that get paid with a paycheck and have a 401k or an IRA or a Roth IRA, we do the same thing every 2 weeks. We put our money in the market. Why? Because people like me tell you to do it. And people like me have been telling you to do it for years. We do the same thing every 2 weeks. We call it the relentless bid. We just keep buying the same stocks or the same index funds every 2 weeks, just like we pay our insurance or utility bill every month or so. We never not don't do that. We always do that, and we become habitual with the way that we invest. Retail investors. Now we're 25% of the market or so. We're not moving the market. We can when we want to, but generally we do the same thing. But so do institutional fund managers as well, especially index fund managers, and especially those that say they're active fund managers. They're chasing the same 30 or 40 stocks, and those stocks propel the stock market higher. And as long as corporate profits continue to grow, and they do, and they're growing even faster now because of companies like NVIDIA that have great margins, but also have higher what we call employee to revenue ratios, where they don't need as many people to make as much money. As long as the profits keep growing, investors are going to keep putting their money in the market because money needs a place to go, and it usually seeks higher ground. And that has been the stock market. And until we stop that every 2 week habitual relentless bid and buying the same stocks all the time, I don't see the stock market having a major crash or
Yeah,
correction
but you
for a
see the
very long
S&P
time.
the S&P 500 warts and all is the perfect mousetrap, because these guys at Ritholtz Wealth, they also discuss factor investing. They discuss things that have not soared nearly as much, such as smaller companies or value companies. International is having a great year.
It's
We have
having a
not
moment.
seen international have a moment for 15 years. Is that too much? I mean, I've even interviewed Jack Bogle and he said, "No, that's not necessary. Just stick to the S&P 500." I'm struck by the bifurcation on Wall Street and among, big investors and retail investors alike.
Yeah, well, I think, what you hear on so-called Wall Street, but it could be Canary Wharf, it could be Hong Kong, it could be any financial center of the world, is we have a better way of doing this. And the fact is, they probably don't. They just have new names for new products that they're trying to market to investors like us to make us spend more with higher commissions so that they can stay in business and play the 363 game. Loan it, borrow at 3, loan at 6, and be on the golf course at 3. Now, I joke. I respect all these people. That said, we've created way too many products, way too many ETFs, way too many different ways of slicing and dicing the same thing over and over again, when Jack Bogle was right after all. And so was Warren Buffett, right? Buy the index fund, buy the fund, sit there, basically do nothing but keep contributing to it. Buy low, buy high, just keep buying until you're ready to start drawing it down. And we all kind of follow those rules. And that's where we are today. The 401k was the perfect vehicle for that in so many ways. Now, it was an accident that it was even created, but it got a lot of us just habitually investing and buying the same things over and over again. So yeah, I worry the bottom will fall out one day, but I'm not going to stop investing because I'm worried about that, because I'll be living like Chicken Little the rest of my life, missing out on generational returns. I've seen it happen, and I've been scared and been tempted to stay out of it, but I'm so glad that I stayed in. And every day that I'm in, I'm happy that I did, even when the market falls.
Caleb Silver, Shadow Fed Vigilante, editor in chief of Investopedia, one of my favorite guests, as evidenced by how many times I've had him on my show. I have not been on your show, sir. I've not been on Josh Brown's show, sir, but that's okay. I'm a
Let's
giver.
change that.
I'm not a taker. I think about my listeners. I think about the general public. Sir, you are uniquely talented. I don't need to tell you this in demystifying kind of Wall Street arcana for mom and pop. And that comes from your place. That comes from the fact that you worked tables as a teenager, the fact that you knew the value of a wad of bills in your pocket. It reminds me of my first impoverished year in Manhattan, where stupid me, there was an ATM on 86th and Broad in this tiny bodega that would dish $5 bills. And yeah, the charge was like $4 to take out $50, but I felt rich with this wad of $5 bills. And yeah, I'm just an old man right now with a long white beard. But sir,
Yeah.
I'm always grateful to have you on.
My pleasure. It's always my pleasure to join you. Thanks so much. And that bodega is still there, but you can also now draw Bitcoin out of it, Robin.
Oh gosh. Caleb Silver, come back on.
Thank you so much.
Thank you.